Hi, welcome back to the channel. Today we're going to be talking about annuities. We're going to go through what an annuity actually is. We're going to go through why, for the first time in my 11 years in this industry, they finally make sense for you as the investor. I'll go through a real world example, and you know me, I have to bring a spreadsheet in. Let's get into it. So let's start at the beginning and answer the question, what is an annuity? An annuity is essentially a very fancy savings account with an insurance company. You sign a contract with the insurance company. It's very rarely, if ever, offered by big banks. So you sign that contract with the insurance company and you exchange a large sum of money for a guaranteed income source for the rest of your either life or a guaranteed period, depending on the type of annuity that you're looking at. So essentially, you are buying an income that is as close to guaranteed as it gets in your retirement. That can sound very, very appealing. So just like anything in the financial services industry, there are pros and cons to any decision that you make. Really, the pros of an annuity boil down to two or three things. They shore up your foundational income sources. And if you have not heard me talk about foundational income sources, all that means is it's the income sources that you wake up with every year that are reliable and not linked to a market. So you'd be shoring up some of those income sources, and you would remove a certain risk. And that risk is that you cannot outlive your money, assuming you do a lifetime annuity. So a lifetime annuity is for your life, no matter how long it happens to be. There are other types of annuities out there, like term certain annuities, where it only pays for 20 years, for example. But on today's video, we're focusing on life annuities that pay no matter how long you live. The cons really narrow down to two things. Number one, it is absolutely possible for your money to outlive you. So if you put in a large sum of money, a couple $100,000, and you chose not to do a multiple year guarantee, which we'll talk about the guarantees a little bit later, and you happen to pass away right away, the insurance company wins essentially that money for their purposes. The other con is that rarely, or at least it's very expensive to add this, but rarely are they indexed. And again, we'll go through an example where I look at an index versus a non-indexed annuity option. What you may be asking yourself now is, why now? Why are you bringing this up now? Like I mentioned at the beginning, I've been in this industry for 11 years, which is crazy to think about when I stop and actually think about that. But for the last 11 years, interest rates have been incredibly low, and looking at annuities has always been really hard for me to reconcile why anyone would do it from the investor perspective. I get why they're being sold because they pay commissions, and to be clear, if you decide to do an annuity through me, I would also earn a commission. But for the first time since I've started in this industry, the math actually suggests that it's good for you. And I have no ethical issues making a commission when I'm helping someone. But for the last 10, 11 years, when annuities really could be outpaced by mediocre investment returns quite easily, the commissions that have been being paid have not been helping people. I have ethical issues with that. And so now, and we're going to go through the break-even math in a second, now they're actually starting to make sense with the increased interest rates and increased volatility. It could really make a lot of sense for your scenario to trade some of your investments for a guaranteed income source to pull lots of that volatility out of your financial plan, which again, we're going to go through in the example. And the investment returns are actually not that bad when I actually run break-even analysis. So let's get into the actual example. So again, this is a real scenario, a real client that I'm dealing with. When we see the software in a minute, I will obviously have changed their name for anonymity's sake, but nothing else has changed. And to be clear, this person is in a good financial position. They're on the cusp of retirement. It's a single woman that has done 30 to 40 years at a particular organization, building up a robust defined contribution pension, which is really what we're looking at for annuities as well. So this person is ready to retire and in the financial position to do so. So it's a great opportunity to look at this type of thing. And so what I did is I went to my software. So as a broker of different insurance companies, which we all are at K4, we were able to get quotes across a number of different companies when we put in a quote request. So when I put in a quote request, I actually get 8 to 10 different company numbers. And so I decided to pick one for the entire example running through. Doesn't matter which insurance company it is. So I'm not going to show the name. If you decide to go ahead and look at this, I would always show all the different options to give the full picture, but I want to just highlight one. So this client is contemplating putting $300,000 in a 10-year guaranteed lifetime annuity. So what that 10-year guarantee means is that the first 10 years are guaranteed. Even if the client passes away in year 1 of the annuity, the remaining of the first 10 years is paid out to a beneficiary no matter what, that's guaranteed. And then lifetime again just means it's over their entire life. If they were to put the $300,000 into this annuity, if we did not add in indexing, they would be getting $1,616.49 per month. If we added a 2% indexing to this annuity quote, that number would go down pretty substantially to $1,281.91 now. But of course that one indexed, and you know me, I had to do a break even on that. So let's jump into the spreadsheet for that. So here we are in a spreadsheet that will compare the indexed to the non-indexed version of this annuity. So just a reminder here, the fixed income payment, $1,616.49 per month. It does not increase. On the index side, you take a big hit at the beginning, dropping to $1,281.91, but it does increase at 2% per year. So there's actually 2 different break evens that I want to isolate and see where they are. First, where does the indexed income surpass the non-indexed income? And that's right here for this client at age 74. They go from all the way from 15,400 up to 19,500 by 74. That's a reasonable break even. And if the cumulative income was on point there, I'd probably recommend the indexed, but it's not. The indexed, or the cumulative, does not catch up until age 85. And in this case, when I go into the financial planning software later, you may notice that I have this client recommended to start CPP and OAS both at age 70. It's rare that I recommend the OAS delay, but in this case, it happened to fit the case pretty well. Meaning that I already have a lot of delays that are all factored around a break even of around age 83. CPP, usually the break even is around 83. So in this case, I'm probably going to be recommending the fixed because I already have 2 things that I'm factoring in that are benefiting her in later life. Here we're going to hedge our bets a little bit without sacrificing too much. Now, of course, this exaggerates the further you get into life. If we look at like 95, it's about an $80,000 advantage cumulatively to the indexed version. Now, the flip side to that argument is these retirement years odds are going to be the ones that you're spending the most. So again, I'm leaning probably a little bit more towards the fixed side so that she has that income to enjoy when she's a little younger and healthier. So let's take that math one step further and let's figure out what the actual break even is on this investment. If I were to have a $300,000 investment, taking $1,616.49 out per month, if I were to use an average life expectancy of 83 on a client, this client is 62 years old in this calendar year, that's 21 years that I have to provide income. That would be a 3.01% interest rate that would be needed to actually provide that income. So that would be the break even. So that's not superb. I could outdo that with pretty mediocre investments. However, when we get to 90 and 95, this is where it starts looking a lot more appealing. If you were to look out to age 90 for this particular client, the break even is 4.7%. If you were to look at age 95, you'd be looking at 5.31%. So now if you think critically about the investments that you're in, If you think your life expectancy reasonably is somewhere between 90 and 95%, you're looking at approximately a 5% break even. So do you have investments right now that are guaranteed to be getting you 5%? If so, is there risk associated with that? Is there any other thing that you should be looking at that's a risk to you or anything like that? And if you can't confidently say, I know this investment is going to be getting me 5%, and I have a reasonable expectation that my life expectancy will be into my 90s, this may be something that you want to be looking at. And with that break-even analysis, you can see the other parts to the trade. Yes, again, you're trading a large sum of money, in this case, $300,000, but you're getting some stability that may or may not be there. And if you're a conservative investor, again, another reason why you may want to look at that. So let's look at actually how that stability translates into the financial planning software. All right, so here we are in the software. And again, this is a real client case. I've obviously changed the name. I do not have a client named Chadette Chadster. Although I will say if your name is Chadette Chadster or you know someone, I will do your financial plan for free because I think that would be hilarious. Anyways, in this plan, I have real spending, so that's today's dollars spending of $66,000 a year. I have a new car column, I have new appliances, I have the annuity in here. And what I wanted to highlight again was the foundational income sources. What I've started actually talking about with clients is I kind of started talking about foundational income sources and renaming it kind of as your January 1 money. And January 1 of any particular year, you wake up and you know your foundational income is going to be X dollars. And that's a very relieving feeling for a lot of clients. And that's, again, one of the reasons why I want to ensure that the foundational income is as robust as possible, because I want to take pressure off of you as the client. So let's pick a year where OAS, CPP, and the annuity are all rolling, because those are the only three foundational income sources that this client has. And they're going to be getting $19,398 plus $28,733 plus $14,539 for a total of $62,670 in foundational income source. And again, they know that as of January 1, 8 a.m. when they wake up, they're getting that $62,000. And if we go across to the spending, that $66,000 in today's dollars has inflated in this projection to just over $82,000, meaning that the foundation, granted these are pre-tax numbers and the spending is after tax, but the foundation is representing 76% of the spending desire for the particular client, which is pretty fantastic. If I flip over to the exact same scenario, except no annuity, so the assets are slightly larger here because the annuity wasn't purchased. If we go to that same year, it's just CPP and OAS, which total $43,262 or 54%, sorry, that's 52% of the spending desire. So the annuity added 24% from 52 to 76 of the coverage that foundational income sources bring to this particular client's spending expectation. Again, if you're a conservative investor, that may be very appealing. The last step, though, is to actually look at the estate projection as well, because in that case, it actually also goes up. If we go to the scenario without the annuity first, the estate projection is, again, it's healthy, $371,390. That's future dollars, and that's after tax, etc. But in this example, it jumped by about $80,000, about $90,000 actually, to $465,000. So not only in this case did it increase the foundational income, but it also increased the estate. Now, again, if you've noticed, if you're taking screenshots and looking at some of my assumptions here, I am very conservative. My investment returns are very, very conservative at 4.5. My inflation is also 2.5. So if you were a more aggressive investor or we had more aggressive assumptions put in here, that trade may not be quite as obvious. So again, every client situation is different, but I try to be as conservative as possible within the software so that when the real world investment returns hit, hopefully you are better So there were a few reasons why for the first time in my career, an annuity may make sense for you as the investor. If it's something you want to explore a little further, there will be a link in the description below that'll come directly to me. I'd be happy to look at it with you. Till next time, keep planning.